Hey everyone, Symbotic reported first quarter 2024 earnings results that has sent the stock price crashing. In this video, I'm going to review those earnings results, highlight what investors didn't like about these earnings results, and also answer if this stock price crash is a buying opportunity or if investors should buy the dip in Symbotic stock. So let's jump into the numbers. Let's look at what went wrong in Symbotic's latest quarter.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
I mentioned already that investors were not happy what they saw from Symbotic, and on the day following the earnings announcement, the stock is down 23.84%, a big drop to be sure. So if you don't already know, Symbotic is an automation technology leader, reimagining the supply chain with its end-to-end AI-powered robotic and software platforms. Symbotic reinvents the warehouse as a strategic asset for the world's largest retail, wholesale, and food and beverage companies. Of course, Symbotic's services were highly in demand in early 2020, 2021, 2022 because the combination of macroeconomic forces were working significantly in its favor. Soaring inflation caused wages for labor to increase, which made companies look elsewhere to find ways to solve around overpaying for workers. So Symbotic was a solution that was highly demanded. Also, during that same time, people were spending more money on things, on goods that need to be shipped and moved from warehouse to warehouse. And again, that created significant demand for Symbotic. So those two forces were working strongly in its favor 2020, 2021, 2022, and even parts of 2023. But now, starting 2024, those forces that were strongly in its favor are still in its favor. Don't get me wrong, but they're lessening, right? Wage growth is decreasing. The availability of labor is increasing. Companies are finding it easier to find workers, and those workers are not quitting as often. There isn't as much turnover, right? Those factors that would cause a company to want to automate an entire system have lessened to a certain extent. And on top of all that, people are spending more money on services and less money on things. And that's also decreasing demand from these warehouses, from these retailers, because they're experiencing lower sales volume. And so that's making their spending decrease. So all of those forces are still in its favor, especially longer term. They're still working in its favor. It's just a near term surge has lessened to some degree. And that can partly explain why Symbotic experienced a bit of a decrease here in the quarter. And investors were not happy with Symbotic's outlook for the second quarter of 2024. Symbotic expects 400 to 420 million in revenue and adjusted EBITDA of 12 to 15 million. So in the most recently completed quarter, total revenue increased to 368.4 million, and that was up from 206 million in the same quarter the prior year, and slightly down from the 391.8 million in the previous quarter. So quarter over quarter decrease for Symbotic, which was not pleasing to investors. The good news is that they did a good job controlling costs. They did a good job controlling costs here. So even though revenue went up significantly, costs didn't go up by a similar margin. So the total cost of revenue increased to 298 million, up from 171 million, which led to a doubling of its gross profit, up from 35 million to 70 million. I like to see this, even if I see companies like Symbotic that are losing money on the bottom line. They're not profitable yet. They're making progress towards profitability. They're demonstrating economies of scale. As they grow revenue, their profits approach profitability or approach the positive level, decreasing the negative, as we're going to see here. So the loss before income tax fell to 12.8 million, a huge improvement from a loss of 67.7 million in the same quarter the prior year, and a big improvement from the previous quarter where the loss was 50 million. So they are making progress towards profitability, and Wall Street does expect that Symbotic will achieve profitability relatively soon. In fact, let's take a look at those expectations from Wall Street. So Wall Street expects fiscal year 2024, which ends in September, for Symbotic to increase revenue by 49%, and then in fiscal year 2025 to increase revenue by 46%, and then another 46% revenue growth in fiscal year 2026. That's going to lead to expansion in earnings per share. Earnings per share is expected to be 2 cents in 2024, to jump to 52 cents in 2025, and then increase again to 72 cents in 2026. So investors are expecting this improvement in profitability to continue for Symbotic. And you can understand why that's the case. Demand for its products and services continues to expand as they offer these solutions that makes it less costly, more effective, more efficient for warehouses, food companies, anyone really that's selling physical goods can benefit from Symbotic services, especially the larger retailers to begin with, the larger warehouses to begin with. And then as they're able to lower their cost to serve, they can become more accessible to smaller and smaller businesses. So one of the concerning factors for investors was the shareholder dilution. Shares outstanding, weighted average shares outstanding increased from 58.2 million up to 83 million from the year over year, and then from the previous quarter, 7 million shares issued, increasing significantly year over year. Shareholder dilution is concerning for investors because it means when the company does eventually become profitable, those profits are going to be split among more shares. All right. And then the other factor that investors were not happy with in the current quarter is the change in cash flow from operations, going from a solid 101 million in the December 24, 2022 quarter down to negative 30 million in the December 30, 2023 quarter. In fact, in the previous quarter that ended September 30th, cash flow from operations was positive 44.5 million, and it turned negative to 30.15 million negative in the most recent quarter. Now, one of the factors that drove this decrease is deferred revenue, which came in at 69.96 million in the most recent quarter. That was 164 million in the same quarter the prior year. Deferred revenue is money that the company has received for sales contract it has signed, but it hasn't yet completed the service. Think of this example. When you sign up for an annual magazine subscription, let's say you pay $100 for that magazine subscription, and it's going to come monthly, and let's say it's 12 issues. In the first month of the year, the company recognizes roughly $10 in revenue, and $90 is deferred revenue. The company recognizes that revenue as each month they serve you your monthly subscription. It's similar here with Symbotic. Not exactly, but similar, where they sign a contract, they make the sale, they may or may not get the cash, and then they have to serve in order to recognize this as revenue. So this decrease, this nearly 100 million decrease, is a double bad sign, because now it signals that the coming quarters, the coming months are not going to be as strong as they were expected to be last year, December 2022, when it secured 164 million in deferred revenue. So that's a factor that investors were not happy with. And so you can understand why the lower forecast, the lower deferred revenue, and the macroeconomic forces lessening in its favor, all of those contributed to Symbotic stock price falling by 23.8% following the reporting. And the stock is still not cheap. It's trading at a forward price to earnings of 59.81. So all things considered, given the factors not working so well in its favor right now and the expensive valuation, I would say Symbotic stock is a hold. It's close to the borderline because I like its long-term prospects. I like the improvement it's making towards profitability, although the valuation is a little too rich for me at this point, given its forecasted revenue and earnings per share growth over the next couple of years. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.